So I just want to kind of, we just ran when we put like 3 months of topics together, and lending was one. So I grabbed that one because I always felt like I knew probably a lot more than the average bird on the lending side, and I attribute that I've had a 20-year relationship with Steve, which is the man in blue back there. We met about 6 months into my business and just formed a great relationship because the 3 or 4 names I had at the time, and then everybody shopped on their own, they'd always come back to he had the best stuff, and I liked talking to him the best, and so that's where we just started landing consistently. But he was always good about keeping me, and I was good about being inquisitive. I think that's one thing about real estate. Always be inquisitive, always be learning, always be finding things that you want to know that will make you better and make you be able to translate some stuff to your clients. So I was always kind of with it on what does a buyer need debt ratio wise. I really didn't want to pull their credit reports. I didn't get into the pieces much, but you could tell, I guess I could always tell, felt I could tell, talking to someone, did they seem like they had it together? I had a very strong clientele base, just always like just picking up the phone, talking to people who called me off a sign, off an ad, and starting to form a bond on what I could offer them on finding homes or details about homes and have a market knowledge, but also, step one, can they get a loan? And a lot of them are pretty confident, you know, they know they've got good credit, they know they've got good jobs, but knowing in and out like which loans you may need. A 30% debt to ratio, 36%. It seems like over time they grow to 40 and 50%. Just so people knew some of those basic formulas and felt confident they could run a little bit of math on their own. And then if I could get that transition conversation going to get the lender in the door to talk to them, I'm not running out and showing them property yet anyway, but I'm starting to form that relationship. And sometimes if I did run out and show something in the old days before we really got astute about bringing people in and doing buyer consults, that first time I met them at a house and talked to them, I was still sharp about the lending process. So I just encourage you to learn that, to know it, and we've handed out some cheat sheets, which we'll go over some a little later, that give a lot of the ins and outs of the types of loans. Just knowing your clientele, because at least I could ask them, were you planning on doing 5% down, 10% down, 20% down cash? Some of those indicators too would give you whether they're probably going to be a conventional loan buyer, or whether they may have to check out, are they first-time type buyers that need FHA and can scrape that 3-4% together, 3.5% now. Or worst case scenario, and Steve and I have always said this, if they've been a teacher and they didn't have any money, that state employees credit union might be their best route. And knowing, sometimes that's the way to go and what doors to open. Because if you can't give them some options that are good options for them up front, that you can wholeheartedly endorse and really be genuine about that's the place to go, who knows where they're going to go, who you're going to get a letter from. I have had several times where people came in the door thinking they were qualified, had a letter, and I found somewhere a crack in the conversation of, was that person available to talk to that evening when they wanted to go that next morning on Saturday when a house was coming on the market, to get my lender in the door to talk to them. And I'd say 1 out of 15, 1 out of 20, they said, don't get in the car. They can't qualify. And they know their business and know it long enough to tell you that. And so that you can figure out how to backpedal out of that situation to know that it's probably not good. But if you, again, know the talk and the walk about what lending is and have a lender who will talk to you openly about what the issues may be at the time with the client, then is it going to pace to a 3-month buy, a 6-month buy, or they say, guess what, they've got 12 more months because of one negative thing on their credit that you have to have pretty much clean for the next 12 months. So that was kind of my spiel about just being astute about lending, dig in, learn about it. We'll talk a lot about it, obviously, with one of the lenders that we use all the time to try to get through what we look for and what we talk about. But really dig into that. I know as a lot of realtors, they think, I don't care. I just get them to the lender and hope they'll talk to them. But a lot of times if they're not forming that bond with you, they don't think you're already very confident in everything, you're not offering them something of value, like the best place to go and why, they may never call them, or you may never hear from them again. You'll get that disconnect. Another thing that glues them back to you is a lender who's keeping you in tune. Someone who says to you, did you know that they went out this weekend and were looking at new construction over there? I get those emails from Steve. Do you know they're doing this? Yes, I do, or no, I don't. We'll want to figure out what they're doing. Because, they will stray, and you need somebody who's a team with you that's keeping you informed. If they hear something, or they're a little nervous, or felt you said something odd to them, if you both have formed a good bond, it's almost like good cop, bad cop. They'll sometimes go and chat to them about something they're nervous about over here, they're not telling you, and vice versa. So I just really kind of look for that, look to form a relationship, and long-term quality relationships in this business are just invaluable. They're just completely solidify, if you're going to be long-term in this business, that when those people like you and or like the people you're sending them to, they will consistently come back to you, and they may even come back to some piece or part of your puzzle first, but still get back to you through the glue of that whole puzzle of people that you put together. I had a guy call me yesterday, just out of the blue, and he said, we went through your house on Gray Winds this week, and we listed 2 in North Raleigh that were good ones, and they sold right away. We liked it, but we need to maybe buy and sell. We really think we want to sell and then buy, so we know what we're getting first. I said, okay, well, he said, we worked with them before, but we didn't feel the people they set us up with as extensions of them were very good. We thought that the inspector was missing stuff. This one was dropping the ball on that. So they liked the realtor. Nothing to complain about there. Loved them. But when it came to those extensions of the realtor, they let them down. And all of us have had that happen. Even, somebody makes a goof. We're all not perfect. But the more consistent you can get with your team players and the people you're bringing around you will really go a long way. Do you want to kind of hit on some of these? We can kind of hit on the different loan programs, and I'll introduce Jennifer. Accessibility, I think, is so important, right? We have to be on demand, working with lenders who will talk to you on an evening or a weekend when you've had that call at 7 o'clock at night. I mean, don't get me wrong, they don't love it. They have to stop their barbecues and things too, but if they're looking for you to take them out a half a day the next day, now that you've built this rapport on the phone on a Saturday night or a Friday night before the weekend, it's good to have people who will take a break and give them 30 minutes of their time that night and get it all right. But most people, I really tell them, and it's true, a good lender needs just 5-10 minutes on the phone with you. Because have you guys had the people who say, oh, I'm waiting on my pre-qual. I'm waiting on it. I'm like, well, what are you waiting for? My people can tell you in 5 minutes. Can I have them call you? That's your other segue, I think, as an agent. I learned after a while, I was always giving them, because I knew the number off my head, and I didn't have to go look it up on my phone, because numbers before you had to memorize. So I would just tell them, hey, call them. And then I would hear back when they did and hear the story, and then it would start up. But I've realized, again, as you kind of sharpen your pencil, it's better to say, is it okay if I have them call you? And are you available? I had a girl this morning, past client, she said, yeah, after 1 today, have them call me. Because then they can
Yeah, I have a couple little key points. So, of course, I'm sure everybody's familiar with your conventional loans, Fannie Mae, Freddie Mac. The good news is they recently have changed the conventional financing. And most of the time, they will say yay or nay, but sometimes they want that $250 to get that condo questionnaire filled out. And who's paying $250 if we don't even know if we have an eligible property? Right, exactly. So, condos are tricky on conventional loans. They're even trickier on FHA loans because it does have to be a FHA approved condo, which is no fun at all. So, so if you have an FHA buyer, maybe condos are not the way to go.
I would say in general, throughout my career, I've steered people away from condos.
Yeah.
I've said just as a fact, even if they're a cash buyer, that all these things do not matter. And that's sometimes when they're the right person for the right thing. They know there could be some limitations in the future, but it still works for them, then let them buy that condo with the elevator and they feel secure, and they're usually, I hate to say it, but usually elderly clientele. Mm-hmm. They just want that interior building elevator scene. No stairs, that type of idea. But most of the time I've steered them away because most every buyer who has to buy one's going to pay a higher interest rate. So they're going to have to pay a higher interest rate. And most every buyer who then owns one, when they sell it, they're going to have that hurdle. There's just so many hurdles that keep coming up with it. that I just want them to be aware, because I'm always thinking if I sell something, I'm going to get it back to sell again, and I want them to be happy, and I want them to be successful. So I just want them aware that there's a lot of limitations that come into play with a condo that homes and townhomes don't tend to have. And a lot of people use the word condo loosely. I think they think a lot of things are condos because they're different markets they're in. And when you explain to them a townhome and how they kind of actually own their little building and own their little patch of land, and they pay some dues and someone does the yard and sometimes some siding and roofs and gutters, and we just have to look at what the fees versus the services are. Most of them are pretty like, oh yeah, I'll take that. It's when you get that person who absolutely has to be in a building with the elevator that then you have to go, okay, just know that I just want you to be aware that in the future you may end up being able to not sell it as easily as everybody else who can liquidate with so many other financing options. Once in a while, something like that can go through a credit union. I would say you can check that.
They're fairly flexible on their
yeah, because they make up their own rules.
They hold them stuff.
And not to be all doom and gloom.
Yep.
We've done condos with 5% down.
Oh yeah.
So it can be done. So it's not terrible.
I just think
I've always been in the same frame of mind. It's not as good of an investment as.
Yeah, I mean, you just kind of have to, you're, you know, knowing real estate, knowing what's good and bad and ugly for people, whether you feel that's a good product for them.
Right.
And most people, if you've built their confidence, they're going to follow your lead on probably what they should buy for their situation.
Absolutely. Did anybody want to have any questions about any loan programs or anything like that? Anything jumping out?
You did say that USDA does have income limits, right?
It does,
I
yes.
think it's like 85,000.
Yeah, it's 84 and change in.
You can pull it up by county.
Okay.
If you go into Wake County, if you go into Google and just hit USDA income limits, it'll pull it up.
Okay.
But of course, that's part of our job. We take care of that.
And one thing about USDA is that while even if you have a family buying a house together and only dad is on the loan but mom works, we gotta count her income too, even if it's hard to track. So, you know, if she's self-employed, they're gonna get all her information and they're not gonna use it for qualifying her to help her out getting a conventional loan. They're just going to count it as in the median income limit, and if she exceeds it,
They
then
will scan the bank statements.
we gotta.
You know,
Yeah.
where's this miscellaneous deposit coming from?
Yeah.
They look, especially if you're doing a USDA, they're gonna look at that real hard.
Mm-hmm.
You guys know the rule of thumbs that they're going to always want 2 years tax returns. They're going to want 2 months pay stubs. All those kind of rules of thumb. So you can mentally, just in your jibber jabber with your client, be preparing them. You know, if they haven't already had a hardcore conversation after being pre-qualified. So when we get that contract, just be ready to start shooting those things over. And I mean, you'll see crazy things. I had a lady work for Duke forever. I mean, well qualified, lots of money, but 12 months, I'm thinking of Rachel 50 in, 12 months of her salary, and one's off by like 2 pennies, be the way they round it or something, and she had to write like a 3-page dissertation about why her income 1 month was 2 penny difference.
So lighten up a little bit.
So just,
I've had that too.
Just be supportive of your lenders to say when they come and complain about this. That girl didn't complain, she just did it and she was awesome and sent it right off. It's just her style. But you know, when they're complaining and hoeing and humming and they want my blood type and my last child and all the things that they say, just keep saying, you know, it's because we had such a crash that now they are dissecting everything. It doesn't have to make common sense to you. It just has to be, it's in their playbook. They have to check this, and it has to exactly match. And if it doesn't, the underwriter has to say, stop, we need an explanation for this. And so it just feels like as they're going through, they're asking for explanations. By no means can they anticipate every single thing an underwriter's going to ask for, but a good lender packages up in anticipation of most of those things, so that's lessened. But still, when those happen and you feel that frustration, or I want to throw in the towel, my husband want to throw in a towel over a refi, because they don't need that stuff. I'm like, they do. I know it doesn't make sense to you, and legally he's Mr. Lawyer, that's not a part of this, but that's what they ask for. We have nothing to hide, just give it to them. Let's not argue with the underwriter. That's not going to win us any favors.
The underwriters are merely meeting the guidelines that the bonding companies that are funding the loan ask for. The bond companies set the rules. So if the banks don't give it to them, then the banks have to fund their own money instead of funding the bond. And we'll tell you, the banks are never going to fund their own money. It's always going to be funded with a bond, because that's where the buy and sell is made at, and that's where their money is made at. So when the clients are going crazy, they just got to understand it's all tied to whether that bank's going to be able to get that bond to be able to fund that loan.
Is VA still around 3% that they have to pay as a funding fee?
It actually just went up to
2.3 and 3.6.
3.6 on the
Okay.
2.3 first time they use it, 3.6 second time they use it.
Yeah.
So they could be exempt. If you have a veteran, they have any kind of disability whatsoever, even if it's a partial,
Yeah.
then there's a high probability they're going to be exempt from the funding fee all the way around.
Yeah. Just know, I've had a lot of clients over the years who came to me just thinking mentally, they're already somewhere astute about lending and said, I'm getting a VA loan. And some people, myself and Steve, have talked out of that. Sometimes it is absolutely the best loan for them. But if they actually had some down payment money, and some of them do, they just think, VA's a great loan, it's 100%, it's no PMI, of course I want it. But what they're not educated on or don't hear or realize is that usually the first time they get one, and a lot of them are the first time they've got one, 3.6% of that loan amount gets added right on the top at closing. So that's a huge adder to their principal balance that they're going to owe back, that they lose, and it's not prorated if they sell it in 2 years. That's just a ton of money. You know, on a $300,000 house, that's like 10 grand. So that's 10 extra grand walking in the door that they owe. And I don't get real comfortable with that. I'm real tight on money. I'm very conservative. I couldn't imagine walking in and getting a loan and going, sure, here's 10 more grand. So for me, I kind of push back against that if the client has other options for us to explore. And sometimes, again, you're a very educated realtor when someone comes in the door and says that, and you pause them for a second and say, are you sure that's the best loan for you? Did you know? And a lot of them say no. And even at the end, they talk to the lender and it's still the best loan for them. You showed value because you knew something and you wanted to stop and in their best interest, see if there was something else for them. So you always, at every step, I think, try to find something that's in their best interest that you're trying to offer to them. For no other reason, just explore it. That's why I always told people, and if you've got a good relationship with somebody that you do lending with, is, hey, you know, if these people tend to have the best rates and the best terms and the best closing costs, don't you want to just give them a shot? It's no cost to you just to get some numbers and compare. And most everybody was like, yeah, you know, okay, I'll have them call you. You know, and people are open to the fact that they're going to get something better and that you've done this a while and you know what you're talking about, hopefully, or they feel like you do, that you're giving them something. No commitments, no hassle, no pressure, no salesy pitch. Just, hey, you know, I think this will be best for you. At least check it out. Mm-hmm.
Question, can you talk more about concession guideline with FH and VA loan? And can you talk about pre-qualification letter, the validation? I know it's 90 days, but the estimate loan amount, can it go up or down? And what if the wife, let's say, lost her job? Another factor with the pre-qualification, can you tell me more?
Sure, absolutely. So if you get a curveball like that in the middle of the loan process where, you know, somebody loses a job or something like that, we definitely do have to go back to the drawing board and figure out what we can make work, and maybe it's switching loan types, and maybe it's adding another borrower. I mean, there's all kinds of ways to skin, a bunch of different ways to skin a cat. So, but unexpected curveballs, you know, we do our best to really try to make it work another way. Usually it can. I can't think of a single one that is just like really blown up.
She's the queen of making hard stuff work.
I do some weird stuff now. I do some weird stuff.
Restructuring a loan, she can do it like that.
Solving the puzzle pieces.
Yeah.
Thank you.
Yeah. But we tend, as a habit, to write fresh pre-qual letters for every offer.
Yeah.
So Sharon had one Saturday where she was writing on one property and they didn't end up getting it, so she needed one Sunday. She told me, hey, I need a revised letter.
But I'm not revising terms, I'm putting address. I always tell my clients, I hate these form letters from all these other big companies that say they're qualified to this and they're gonna put this much down. Like, they don't need to know all your client's business. If you're only writing an offer on a 350 house but they qualify to 500, do I need a letter that says that? No. So I just always put that. I asked Steve to say, you know, which he does. He's already checked their credit. They're well qualified, and they can buy 123 Maple Street. And that's all they need to know, and then I go in and negotiate. And I've never had an agent push back on me and go, well, you're going 10,000 over the asking price, how do we know they still qualify? They've never done that. Where I have had clients who called their lenders and they said, okay, I only want to go up to 450. And they have the letter for 450, but then we go for a 460 house. Well, and now it's the weekend. And now that's the only thing I've got to send if they're not willing to talk to one of my guys. But that's usually my crack in the egg to get my guys in the door. Is to send that, and then if you had to bid up or whatever, you know, like they're like, well, this letter doesn't match. And I've been on the listing side too of that, where my seller sees some of these things. They're like, I'm not so sure that they should buy this house. It doesn't look like they can qualify. They're right at their limit, or they're right, you know. So you psychologically, you want to feel like you're not giving away the farm, telling them they can don't qualify for double, so push them on their price, but you don't want one that's so close to the limit that the seller starts doubting if they can counter offer to you if there's multiple offers and things. So I just always I just tag them real quick, can you send me one with the new address on it?
Okay.
Yep.
Now, on seller concessions, yeah, so that is something that we would probably communicate about through the whole process, because depending on the type of loan and the down payment and all that stuff, that can vary, but 3%, we price our loans. Let's say we're doing an FHA loan and you can use like 6% seller concessions. Well, we don't have 6% in closing costs, but they can use that to pay for their inspections, their prepaid items, all that stuff. But if it's somebody who is maybe a little tight on funds to close, we price ours with a lender credit. So we want to make sure that we're not having them leave money on the table, and we can adjust their rate accordingly if you were able to negotiate everything being paid by the seller or a certain amount. We can kind of coordinate to where
The client
we're maximizing what they can use without leaving anything on the table, but generally between 3 and 6%.
Yeah, if you guys written contracts with closing costs in it, and I know a lot of us can't these days, but back in the day you could. I feel like people come in and go, oh, I want $5,000 in closing costs, but they didn't really even know what their costs were going to be until they really now locked in the loan. Well, now the rate and the way it paid the lender in the back, they were able to adjust it a little bit. That all they had was $2,800. Well, the way it used to read was, well, anything you couldn't use, you lose.
Yeah.
So be communicating, always finding out like what those numbers are when this market shifts and you can put closing costs in, that you're running it pretty tight on what they can
And
use.
usually in our pre-qualifications, that's what we end up coming up and doing is when we're talking to the client, we know what assets that they have to work with. So one of the background things that we're going to do is, okay, if they only got $8,000 to work with, but I know the down payment's $7,000, how do I bridge that gap? We know you're not going to get seller pay costs right now. So I don't know how much you guys know about mortgage brokerages, but based on the interest rate you take, you get certain costs and credits with. We don't get to play with the numbers and keep anything we want to keep. We're regulated. Anything that's an overage on our rates go automatically to the borrower. So we might show them, I had a 275 VA 30 year the other day. I showed them a 275, 2875, and 3. 275 may have no credit. 3 might have a half a point credit to them. So they'll take your loan amount that's $200,000 multiplied by 0.005, and all of a sudden they got $1,000 credit towards their closing costs. Okay, so we try to show them how to bridge that gap. And yeah, they might be coughing up $20 a month on their payment, but it might be bridging down that $1,000 gap that they need to have because they don't have it. Okay, and if you start doing the math on a lot of this stuff when we're educating our clients, for every eighth of a point, yeah, it might be $20 a month, but your break even might be 5 years down the road. What are you going to be doing in this house? Is this a starter house? Are you just getting in it to get started in it, and you're going to be out because your family's going to grow in 5 years? Is this your forever house? And if it's your forever house, then we're going to look at lower rates and depending on the market. Like right now, you're going to take it as bottom as you can get it, okay? Because you're never going to refinance what you're getting right now. A year and a half ago, when they're in the mid-4s, yeah, those refinance opportunities were probably going to be there. So that's when you start playing with the rates where you make the costs go away, because you're probably going to climb back in 6 or 12 months anyway. So why waste $3,000 on closing? Keep the money in your pocket. We'll deal with it later down the road.
Because you guys have seen lenders that advertise no closing costs, no fees, right? Well, how they're doing it is they're giving you, say, 0.25% higher. If our going rate today is 3.5, they'll run it at 3.75, 3.875, whatever that number is on that day that yields them in the background extra above and beyond what their normal commission was that they would get on it, and they reapply it as a lender credit to their closing costs. So that's how that's done. There's nothing free in the world. So, but analyzing that, and they're really good about that, especially we've got a lot of high tech and smart math people, you know, in our area with the research triangle, that they can lay it out and they can handle it. Some people, you know, they can't handle it. You just know where to guide them, and that's where they land. But to know that, hey, we can go here and you can pay X, or we can go here and you can pay X. It's not just, here's a rate. Because people who only shop rate, they're usually getting screwed on the rest of the terms.
Yeah, we're gonna make them think. We're gonna give the clients always 2, 3, 4 options. We're gonna make them think about what they're spending and what they're not gonna spend. Every single time.
And a little bit of a 5-year analyzation, like they said. Like, most people are gonna stay in a house 4 or 5 years. So at what point, if we paid that little extra rate and had a little bump on our payment versus putting $5,000 out in closing costs up front, where is that payback? If it takes 10 years before I break even back to me, then I'll probably take the bump up on rate versus paying the $5,000 out, because I'm gonna be gone and already feel like that money was back in my pocket, you know. So just know there's a lot to lending other than just, hey, what's the flashy rate online today, or what somebody's saying about the rates. Last week, like I said, Steve said to me out loud, and 2.75 on a VA loan. If y'all don't know VA, that's one thing, at least correct me if I'm wrong. Other loans, there's all these little like pieces and parts rolling around in them of what you can say and not say. But VA is VA. You qualify for VA, you qualify for VA. You've got your veteran certificate, whatever number you qualify for. And by the way, they don't have limits anymore. I heard that recently. They totally took off the limits. It's limitless. You qualify, they'll go up to whatever they feel your debt ratio is qualified
However,
However,
there is a catch.
there's always a catch. Once you take that loan amount above about $550,000, then the banks do have overlays with the interest rates.
Okay.
If you're under 510, yeah, we have 275 all day long.
Well,
Get up
if
above.
I had a buyer write an offer on a property of mine that had been sitting, it's right up the Durham County line, and it's a little quirky older house, so it's been sitting about 3 weeks. So they brought us a VA loan. We didn't have any other competition. We're more than happy. Usually it's hard to get VA loans accepted today. More than happy to take it, but they were going to get 3.125, and literally within the day, Steve said, I just locked somebody at 2.75. I was like, I can't help it. I'm going to tell this agent, for the good of your client, just see if they're interested in talking to Steve. The loan's the loan's the loan. Like, if they qualify, they qualify. It's not, oh, well, if you only have this credit, you get 2.75, and this credit, you get 3.1. I could speak that right off. I knew this guy could get 2.75 because Steve just locked somebody at 2.75. Others, you have to know, are they 620, are they 640, are they 680, are they 720 on their credit score to know what rates they could get, and that's where you leave it to them. But on that, I could just say, hey, you might want to do that. One, it helps them, but it helps me as a listing agent know he's got control of the loan. I don't have to worry about a thing.
Sharon, I was going to ask, how involved do you get when you're on the list side, or, you know, when you get those pre-qual letters? Do you reach out? Do you? I
personally don't. I vet mentally. I know who in town has been easier to deal with versus not. Honestly, as long as they qualify and all the other terms are good, I'm good with it. Most people today, I haven't seen, and here's why. I haven't had any loan failures on the buy side in the last few years, right? I don't have any risk aversions right now. But I do know in my mind if two things are pretty equal, and one lender's local that I consistently see does a good job versus one lender is some national, you know, advertiser on the TV all the time, I might lean my seller towards somebody a little bit more local if all cards are equal, because I just always feel like it's better when you can, if you're worried about something, pick up the phone and talk to somebody directly, or no, you literally could go sit at their desk and talk to them about it. I'm sure, I mean, some of these national companies do a decent job, but it's still, I like the local feeling of it. I do hate one of the big ones. They call and harass me all the time. I feel it's harassment. They want to tell me every little thing and give me these phone calls about where the buyer is in their process of loan. I'm not their agent. They shouldn't be doing that. That's, to me, a conflict of personal information, honestly. We have a due diligence contract. You're in or you're out. I really don't need to know anything else at that point once I've accepted your offer. So I'm not somebody who sits there and, oh, let's call the lender and see how far along they are. What is that gonna matter? The buyer's either gonna be in or out in due diligence, and that's just kind of what I boil it down to at that point.
The speed of time range right now, since the revise.
Slowing down. So, things have been running very, very smoothly. However, with the interest rate drops, the banks are starting to, we have just had a huge influx of refinances. So that slows the banks down, slows the appraisers down, and the attorneys way down. So,
Kind of be mentally
really
adjusting some to that.
safe mark is like 35 days. Just it just allows us to account for any if they have trouble getting the appraiser out there, scheduling the inspection or anything like that.
And to be honest, that's the bulk of the issues right now.
That
I
really
know y'all
is.
are worried
Our part
about due
is-
diligence dates. That's probably one of the larger things. In due diligence dates, if the appraisers can't get there, then you're in bad shape. The loans we know work.
Right.
We're not starting unless we know it works. So I'm not worried about due diligence from approval or non-approval. All we're worried about is can we get the appraiser out there and get him back?
And that we just don't have any kind of control over who the appraisal is. They don't even tell us who it's been assigned to as far as the appraiser goes until that report has gone through, it's been turned in and gone through QC. So it's like, I can't even call and harass an appraiser because I don't know who it is. So,
I think that's always the tough thing, is because if we're bringing first time home buyer, we're going up against maybe investors that
Absolutely.
house, trying to work out that time frame right now. And trying to
It's
work out due diligence, and I know we've extended a lot
real
of
balancing
diligence for appraisal purposes only,
Yeah.
and that seems to help a lot.
That's the easy part. If you can do that, then the rest of it's easy. Because like I said, we're not gonna start the loan unless we know it works.
right.
So,
I've had to have, I had an appraisal issue. There, an inspector had gone out, inspected the property, and there was an area to the property that was locked and they couldn't get in, so they had a really hard time coordinating getting back out there, which significantly delayed the report. And so I just wrote the listing agent a commitment letter, you know, that said, we're all good except we just gotta have the appraisal. And with that, they would extend it, so.
Are you seeing agents work with you pretty well on extending just for appraisal purposes, the GD?
Yeah, I mean, the few we've had to do, I don't think we've gotten a lot of pushback because they understand everything else is closed out but the appraisal at that point.
Just with this market being so crazy,
Yeah.
you know?
I mean,
Fun times.
and I think it's gonna get very much worse the next couple of months. Just knowing what I'm seeing on the list side of what's coming in. And now again, I just have a young couple trying to buy in that 350, 400 range and carry. And I mean, we laid out the gauntlet on this last one. And didn't get it, but didn't even get what frustrates me, if y'all ever on a listing side of one of those, is I can't get communication back from the agent of why. They don't have to tell us a detail on their offer, but I said, what term? Just give me peace of mind. Was it price? Was it the fact that we were 20% down and you had cash? Was it due diligence? Like, could you just lead me just so I can make them feel better, especially if it's cash, because I already warned them we'll probably lose to cash. You know, tell me. And all she keeps asking me is, will I write a backup offer? Well, if you might tell me this, then I can get them moving forward on the backup offer. But they just want peace of mind to know what was it. And just, like, tell me that. Like, that's no trade secret, people. Y'all can share that. You didn't tell what the other terms were. You just said which pocket of terms or term you didn't win on. It's just helpful.
Counter you back on that term too.
Yeah, yeah.
So you always ask for it to counter, you know, might be price and see what their counter could be. Could be the exact same offer as the one having the table.
Well, anytime I take a backup offer as a listing agent, which I've got 2 on my table right now, and so I may have one as a buy side too. Clearly, we're not taking one that's substantially less or different than what we've currently got on the table. What would be the motivation of that seller to try to be ornery and not fix things or make that one go away if the other one's not better? I just had one, this same little older property got the VA buyer on. They brought me a backup offer that was like $18,000 less than asking price. I'm like, what are you doing? You just have to ask me, well, what are you thinking? Like, unless you're giving us the asking price, because it was on the market, like give them a little bit off, but we didn't give them much at all. What are you thinking? And, you know, I just don't know if they don't have the knowledge, experience, or how to tell their client, like, what's the motivation for them to take that as a backup offer? So.
That, make sure your attorney relationship is solid.
Yeah.
Because the attorneys get backed up on doing title work frequently. So there's points and times when your lender's gonna say, hey, I'm in good shape, but I can't get title. You know, we're not closing until we get title. So just make sure that you might have to pitch in and tell your attorney, hey, I need this done. Because it's magical when a realtor says, hey, I need this done. Attorneys seem to move really quick.
Much faster than when we badger them, yeah.
Yeah. And I was thinking about the other concession type things that we ran into during the crash and everything tightening up and changing. They would not allow you to almost even write a refrigerator in anymore. It got really weird and tight on things. Now it seems they've loosened back up to fridges and washer and dryers.
Yeah, loosened up, but still, if there's like, you know, a trampoline in the backyard, a hutch in the kitchen, and you're leaving grandma's china,
yeah,
the underwriter's gonna have.
But you need to put those on more of a bill of sale.
Yeah.
That's just a separate document that says when you close, they're gonna be there for the client. Because they don't need personal property at that level.
Appliances,
I feel like sofas, TVs, somebody sells them their theater room equipment, something, they just don't wanna see that.
Theater
stuff
room
sometimes.
equipment's a big one. They will make you take that
Yeah.
out or reduce the purchase price by that value.
Yeah, so just hedge that off. And you guys know about allowances. Most lenders are not allowing allowances for things. So when someone says, I'll give you a $3,000 carpet allowance, that just means you're gonna use $3,000 for closing costs, or you're gonna take $3,000 off the price. That they're not gonna allow you to do allowances. You can get creative. We get creative on our due diligence agreements because they don't see it, so close your ears. That we can write on there $3,000 to XYZ carpet company will be paid out of the seller's funds at closing. And then that check, at least the buyer can walk out with and go buy their carpet. Those types of things. Or if you just say, which we have one right now, like colonial white granite is being installed. It's because we showed it before we had it installed, but we had the sample in there and it was going in regardless. But the agent does not need to not write that in, because then we could somehow craftily pull that. If you see something disclosed in a house that's being left or being kept, don't just assume you don't need to write it in. So they wrote in, you know, this colonial white granite will be installed in the kitchen prior to closing. So those types of words, but things like numbers, number credits, they don't want to see those. They don't want to know. Don't let your buyers think they're being really savvy and sending the lender the inspection reports or sending their home insurance company unsolicited inspection reports. Now it opens up all these cans of worms of things you're going to have to start chasing and getting fixed and satisfying people on, or switch lending or switch insurance companies to avoid all the chaos they just created. Some people, I don't know if y'all run it, I run into one or two every once in a while where they're so excited and they want to tell everybody, you know, and you're like, this is not helping. So, you know, try to keep them under control, tell them run everything by you before they go do it on their own.
Fast and loose.
Yep.
Yeah.
Is seller possessed, so we're doing a lot of where they might be first time home buyers, but letting the seller stay in the home after closing to a certain point?
There's a rule that if you buy the house, you have to move into it and occupy it as primary within 60 days. But there's no problem with seller rent backs for a month or a couple of weeks.
Cool.
Yeah. They do sign that form if y'all see that at closing. They do sign a form in the loan package that says it is their primary residence. Because again, if they're not an investor, they got a better rate as primary. Know that too. Investors pay higher rates, and evidently right now, much higher rates. It used to be about a half a point difference. Now it's like a point.
It's crazy right now.
Banks they will do a loan at 20% down investor, but they really don't want it. They're throwing rates up there that are just ridiculous.
Yeah.
You do 25% down, you can get investment property under 4.
Mm-hmm.
But if you get 20% down, you're probably staring at a 4 3/4 or a 4 5/8.
Yeah, it's nasty.
So we're encouraging, you know, we always show clients both ways. It's kind of a no-brainer when we talk about 3/4 of a point difference between putting an extra 5% down.
Yeah. And if a family member buys the house cash, how fast can they hurry up and get how fast can the buyers
Refi,
if
loan
the parents buy the house cash, when can they refinance?
Generally the hard rule is 6 months. I feel like we have done after 3, right?
Actually, yeah, they loosened it down a little bit.
Yeah.
I think you can get it within 60 days. But now there are certain limitations tied to it that they're going to be looking at real hard. And there are also interest rate overlays. So, because when you talk about a cash out refinance, which is what they're going to consider it, versus a rate and term refinance, you can expect a quarter, even 3/8 of a point hit in the interest rate versus what the regular, if you're doing it going in.
So a ribbon would be separate from the 60-day rule, right? Ribbon would be separate?
Yeah, because that's a sale. They are an entity that is selling that property to somebody else. So yeah, that's considered just a whole nother sale. Not a
But y'all know,
refinance.
because of a lot of the flipping rules, that if somebody bought for any reason something much lower than what they could turn around and sell it for, not flipping necessarily have to be, but even like between family members, like, hey, I know you got a good deal on that house, now if you just fix it up for 30 days, we'll refinance it at a higher rate for, higher loan amount. They're not gonna allow that. I think you have to do at least 90 days on those, and you have to really show proof of
Right.
what's been invested in the house
it
for them to
loosens up.
justify the new
It
appraised
loosens up
value.
after 6 months, but yeah, in 90 days, they want receipts and everything, yeah.
Yeah, I got caught on that on a rental property, that I sold. I told y'all the story before, but basically someone bought a townhome. I had no idea because it was an older community. They had internally switched and it wasn't posted anywhere that I could find that they had switched it. You could not rent. So once I sold it to my client, this $150,000 townhouse, you can't see those in North Raleigh anymore, I had to buy it back from him and resell it. Well, I got a good deal for him on it. That's why he was an investor. So I was selling it for a little bit more money and making up my differences of my damages that I had. And it was working great until the guy, I guess he was FHA or VA or something, and they said you have to wait at least 90 days. And that guy wanted to cuss me out. I'm like, it's your loan program, not mine. I could sell it to anybody else on the street tomorrow and then close just fine. But we all just delayed about 30 days and got it done. So.
Remind me from listing agent side, FHA, if you've got an FHA buyer, let's just say for some reason deal falls apart, appraisal attaches for how long?
6 months?
Yeah, the appraisal is good for 6 months. If they're switching lenders though, it has to be transferred.
But let's say deal falls through with that buyer.
Next FHA buyer comes along, they have to
Next
reuse that.
buyer FHA
Yeah,
comes
they do. They
along,
have to use
is that appraisal,
It's
how long
locked
is
in
It
for
that?
6 months.
Right, and it goes into the FHA
So
connection.
database.
So they are aware of it, but the bank is gonna require a second inspection for a new buyer.
A new appraisal, okay.
Oh,
Have you ever seen them transfer it? Like to a new buyer? I have not.
I have not seen it transfer to new buyer, but
I've always-
there's
But
some.
don't they-
But the
points
fact
in
it's in that database.
It is in the
still
database.
probably
It
causes
is.
problems.
It
My
does
gut
cause
would tell
problems,
me
yes.
4 months.
Okay.
Most everything with appraisals are good for 4 months, and then you start doing restart of values and so forth. I mean,
Is that the same with VA also? Or
Mhm.
just FHA?
Just FHA
Yeah.
is sticky when it comes to appraisals. VA is done kind of totally separate. It's contracted through the VA website. We don't order those through the bank or anything like that. So I imagine VA works just like a conventional appraisal, that it's specific to the borrower, and if that falls through, you can't transfer it. Anything else you want to hit on?
I think of pitfalls. Oh, an interesting pitfall I ran into. If y'all have any of these, pipe up and speak about them, because I think they're learning experiences. I had a property, some people really wanted to buy. It was like 4 or 5 acres with this little old-fashioned 60s brick ranch on it. But it was exactly what this couple wanted. We go under contract. It was back in the day when things were much more affordable. Only to realize, this is the people with the comment.
land home ratio, yeah.
Only to realize that if the land is more than 50% of the total package, the house itself was not considered to be very valuable in the total package price. Then it's considered a land deal and a land loan. So no longer could we get a loan on the property.
And that rule still sticks today.
So be aware of that.
House can't equal 50% of the total sale package.
If you have kind of a crappy house or a little tiny cottage on some decent piece of property, you know based on its location that most likely the property is worth more than 50% of the house, they consider that house then a tear down and they will only lend against it as a piece of property. And a lot of those need 30-50% down, and if
Right.
that's not what your buyer is, that's a problem. That one we had to take to a credit union. They would do it. But in general, just that was a new rule to me. I've only run into it once, but it, threw me for a loop. I mean, good thing we figured out an alternative, but I wouldn't have been able to warn that up front. Now, I've almost run into it a couple more times, and I know to warn for that. We need to look at what the value of this land is.
So can you repeat it, if the land is worth more than
50% of the total price.
Sales price?
Mhm. If the bank's appraisers or the, value looks to be that it's more land heavy and more rich on land, and that the house is most likely in their formula, then these people didn't tear it down. It was a cute little house and they live in it. But that's how the rules are, is that then it's considered the house is almost, just a negative to the land. So.
Let's talk a little about rates. I'm sure you guys have heard the Fed cut. Now, I don't know how much you guys know, but the Fed rate is not the same as long-term mortgage rates. That's your car loans, that's your equity lines and so forth. So with the 0.5 point rate yesterday, that doesn't mean rates are dropping down. Matter of fact, long-term mortgage rates tend to move 2 to 3 weeks before the Fed makes any announcements. In my 23 years of banking, we get these weird rate drops. And you sit here and go, okay, when's the news coming? Something's coming out in the next week or two. And of course, that's what came out yesterday. So if your clients are working you over about rates, should I hold off? Should I wait? Are they going to lower the Fed rate anymore? Just tell them that doesn't affect long-term mortgage rates. It's an indirect, but it is not a direct. Okay?
Was it coronavirus?
God, I'd have to figure that out now. 4.25?
Yeah, I think it's 4
This is correct.
4, I think.
Uh-huh. It's
Somewhere
down to
around
4.25. I think it was at 4.75 before yesterday's cut, which would take it to 4.25. Now, most of your equity lines are usually tied to a prime plus, prime plus a quarter, prime plus a half, or something like that. So just understand, the 30-year fixed rate's around 3.25 right now. The VA rate's at 2.75 on a 30-year. 15-year rates are around 2.75. You can get 2.625 with a little bit of discount point. But rates change every single day, and of course the big thing, which is why you never see us really advertising rates, also depends on your client and their scenario. There are overlays that can affect the rate between equity in the property, their credit scores, what loan program they're looking at. When your VA rate's 2.75 and your conventional rate's 3.25, that's a pretty big swing. Okay, and the people always like to walk around and say, "Hey, I just got this." What they don't ever tell you is what program it was and what their scenario was. Whether they got a 650 credit score or 760. So there's a lot of variables tied to it.
And you guys can lock it in. If somebody has I don't know, Bank of America, let's say Wells Fargo, they have a really long-term relationship with Wells Fargo, you could lock them in with Wells Fargo still, right?
No.
No, they don't.
Wells Fargo does not do
Bank of
wholesale
America
loans
got
anymore.
out.
They got out of wholesale.
Yeah.
They got out.
So only wholesale banks. We still have a lot of big ones, but Wells Fargo dropped, and they did it after everybody else had already done. We thought Wells Fargo was in for the long haul, and they just one day they just packed up shop and was like, nope, we're not gonna. They had to buy back. What was it? It was like an atrocious 6-figure amount of loans, and they just said, no, we're not doing it anymore. So
It was one of my harder days having my bank rep call me up in tears driving back from South Carolina.
yeah, we use them a lot.
They were in a corporate meeting about what was going to happen for the year. Day 2, she got a pink slip. Thanks. Thanks for driving down here to Beaufort, South Carolina. Here's your severance package.
And if somebody has a rental property, does that debt, like they'll say your rental property has $900 is the monthly payment, but you make $1,300 from it. Like, is that considered income?
It can be. It depends on what you file on your tax returns, how much you would write off. So we would do that. Generally, when people have a rental property, we get the tax returns out of the gate so we can review and do the income calculation. If it is somebody who does not have a 2-year history of renting, then we can offset it with 75% of their lease and some deposit checks. So at least we're not counting the debt, the full debt against them. So there's some ways to work
But the
around that.
appraisal, when they do the appraisal, has to have what we call a comparable rent schedule at that point. So normal appraisal is 5,525. But then if you have to use that comparable rent schedule to offset the debt, then they're going to spend about another $175 to almost $200 to get a comparable rent schedule out of the appraisal.
But it's worth it if it's between getting a loan and not getting a loan.
Yes.
Some of their banks allowed about $100 to $150 appraisal rush. So it's 200 now. Okay. So just know that. So
95 now.
So if you know you're in a hurry and you're locking in with a lender that'll have that feature, you may want to explore it and encourage your people on these type due diligences and competition to cough up some money for an expedited appraisal. But not all lenders offer it. They go to various banks and pick the best ones that are running with the best rates and the best service at the time. Because different banks want to provide different markets. Sometimes they really want 15-year notes. Other times they're almost equal to 30 years. So they're not buying into the 15-year notes and things like that. I don't know if you guys have seen, but even 15 years are super low. What are they, the 2s?
275. Actually, I quoted 265, only have a point discount.
That's some crazy refinancing if people aren't moving off to get their main loans, if they've had them a few years, down to some 15-year notes at 2.75. I mean, that's some crazy cheap. I use the phrase now, they're giving away money. Like, if they're back.
It's pretty
giving
cheap
away
right
money.
now.
Most of the clients, if they're sitting at like 4 1/4, you can go from a 30 at 4 1/4 to a 20 at 3 1/4, and your payment doesn't change.
Doesn't change.
You just shave years off the mortgage. So we explore all that mess.
Anything else?
Probably having a lot of buyers right now calling, I mean, kind of think what you went back to, they're under contract, they've already locked the rate, and now they hear the Fed's dropping rates.
Yeah.
How do you educate the buyers?
Sorry, go ahead. It never hurts to ask the question, because I know our phones ran off the hook yesterday, like, can we get a lower rate? Well, you know, the truth is, if the market moves significantly, we can renegotiate to a lower rate, but it does have to move pretty significantly, like a point in credit, not a point in rate, but a point in lender credit. And then we can renegotiate to the next rate down. But just because, as Steve mentioned, just because the Fed made that cut, it's not a direct impact on mortgage rates. So if I didn't give that speech 5 times yesterday, and probably do for another 10 today.
It was already baked in a week ago.
Yeah.
In the rates, but, Jen talked in point system. I always kind of keep it a little bit on the simpler side. If it drops a 1/4 point in rate, they'll give you an 8. They're not gonna let you have your cake and eat it too. So it just depends on where they're at and what they know, what they're.
Yeah, everybody's policy is
Yeah.
different. But it is an option if there's significant movement in the market.
What I tell clients too, banks don't call you when rates go up. Sometimes you lock in your rate, and you made a choice.
Yeah, that's something to the whole, like, are you ready to lock in? Because when you've got 30 days, 35 days to get this loan done, they got to just get it done at lock. They can't wait 2 more weeks and go, oh, rates are better.
Yeah.
You know, it's just, you gotta keep moving, keep the loan moving.
Well, I want to let everybody eat, but I just do want to give like one little more talking point on something that I think might be really helpful, particularly with the with contingent offers and how they're not going over so well. If you have